investing or utilizing windfall gains. These are essentially a lump sum of money that you do chance upon. It could be due to an inheritance that you may have received from a relative, from a father, from a grandparent, from your mother, or it could also take the shape of this bumper rally that we have seen in the equity markets, which has, of course, led to a lot of individuals making money in the equity markets. So how should you properly invest and utilize this money? We have with us Anil Rego, the founder and CEO of Right Horizons, to talk about this topic. Mr. Rego, thank you so much for joining us on ET Now. Before I ask you about utilizing this lump sum money or expectant lump sum money, it's sometimes very overwhelming when you receive so much money in one shot, when you receive this windfall gain in one shot. So in your experience, what's the most common mistakes individuals tend to make when they chance upon such windfall gains?
I think the first is that, maybe they spend too much of it and do not plan. We had this case, for example, where you had one of the persons who won the Konbanega crorepati, and it was much more than a crore, and he ended up spending all of it. So I think our expenses can expand to fit. So I think that's the first thing that you need to be careful about, not to overspend, okay, and think that, this is an unlimited pool. Very soon you may find that it's gone away. The second is about actually, making some of those wrong investments. If it may be overwhelming because suddenly you get this money and you completely go back and take advice of people. A lot of people may approach you saying that, okay, this is the best thing for you, but later on you may realize that it may or may not be the best thing. So making some of those wrong investment choices is the second one. And what can one do to address that? Maybe to plan it a little better. And maybe spread it out. The other part is about not consulting with somebody who is an expert. And at times people come back and say I am an expert, and it is difficult to make that choice. But maybe spend a little more time, especially when the monies are larger. First of all, whether you have the good tax advice, because is there something that you could do to save taxes? Number one. So that the amount that you have is more. And the second is, how do you have an advisor who maybe has managed some of these windfalls? Go back and if it's a larger sum of money, even go take a reference, understand that better, and maybe then you are better equipped to take that decision. And the last is probably in terms of making a proper assessment of your risk profile. And so when you get that money, suddenly you may go back and invest it. Say in equity markets, and what if it's at the peak, right? So you need to be a little bit careful about understanding your risk profile. Don't get carried away emotionally by what is happening. Maybe what you are doing on your smaller portfolio may not be appropriate for what is there on the larger windfall that you have. So it's important to understand your risk profile, and we have had people which say that, okay, I can take a high level of risk. Okay, I can do it, but then at the first fall, they become very, very nervous. So that is the point to have somebody who can maybe even make that assessment for you as to what is the right risk that you should be taking while managing your windfall, because it's a combination of, it's a question of risk versus return. Okay, and that is a balance that is very important to achieve.
Oh yeah, I think we'll explore that topic of risk a little more in detail. Excuse me. But let's talk about investing this windfall gains. I mean, Mr. Rego, you've got this money and, you don't really have a plan. You don't have any obligations as well. Let's assume that. Should the first thing that you should do then with that money is take it and, invest it? And how would you recommend individuals go about investing it, assuming they're starting from zero with their investment journey?
Yeah, so it's very important to plan for it well, especially if it's a larger sum of money. Okay, at the same time, just putting it away because it's overwhelming is also an issue. And we had the case with the client who almost like for 1 year a very large sum came in and he missed out maybe a good rally in the market and various opportunities at that point of time. So it's about how do you find the balance? And I think the first thing that you need to do, maybe as soon as the money comes, is go and put it into some liquid investment. So, example, you can put in, either an ultra short term or liquid fund, or in a short term bank FD with 15 days and rolling over. So you're not under pressure to just suddenly go and sort of invest it. So that's the first. The second is, once you've done that, and hopefully if you know about it a little bit in advance, then maybe start your planning earlier itself, right? Okay, how am I going to invest? Because that planning may take you a little bit of time. And like I said, you may even need to, if you don't have an advisor, you may even need to identify an advisor, and all of that, you don't want to be taking decisions in a hurry and rash decisions. So that's the second part. Go back, identify somebody, do the planning, okay, and once you have the planning, start making the investments, and keep a limit to the planning time that you have. And in worst case, what you can do is say, okay, if you find it overwhelming, say set aside and say, I'll start off with investing 25% or 50% of the amount, okay, right now, and the rest of it, let it lie in the liquid fund. I will, over a period of time, you don't have to take all the decisions together. And you may also have investment opportunities which come in later, right? So you may want to keep some of that money there. And once that has happened, once you've done a plan, you've diversified, it's very important to look at various factors. Look at, what are the right asset allocations for you based on your risk profile? What are the avenues that you can use? How do you, where are market conditions? Is market at a high right now? Or is it at a low? So what are different asset classes like, whether it's gold, whether it is debt? Okay, so there are a lot of factors that you need to look at. You need to look at the tax efficiency of your investment as well. Okay, and then sort of go about and start deploying it one by one. And I think once you made a plan and say, okay, I want to deploy this X% of my portfolio to start with, okay, then just go ahead and do it. But do it in a diversified way, do it across investment assets, and keep some money for liquidity. Don't put everything locked in and you struggle with it later.
Okay. Now, let's talk about this whole thing of investing versus paying a loan off. Many individuals have had to take on loans, especially in these last couple of months. Of course, those are extenuating some circumstances, and chancing upon a windfall gain like this is definitely a big silver lining. But otherwise as well, right now, given the low interest rate environment, suppose somebody is, slowly paying off their EMIs and then they chance upon this windfall gain. Would you advise, first applying the money towards prepaying at least a big chunk of the loan, or, do you recommend looking for investment avenues or, building up an emergency fund? What would you recommend between the two?
You may have, loans which come linked to the asset as well. So, for example, if you sold an asset and there's a loan linked to it, so sometimes you may be forced to, let go of the loan first and then, it will release that asset. So in that case, you may not have a choice. But let's assuming that it's not on the same asset that, has got you this windfall, then I think you need to make a decision as to which is better, right? And the simple way of looking at it is, if I invest it out on a post-tax basis, can I get a better return than my post-tax cost of my loan? Okay, so because sometimes it's you may have a tax benefit on your loan. If you have a tax benefit on your loan, then you have to look at it on a post-tax basis on both sides, both from what you expect from your returns and as well as what is the expected post-tax cost for you on your loan. So that is a fundamental principle that you need to look at. But at the same time, there's another angle to it, and the other angle to it is about risk. Okay, and if you've got a windfall, it's also, I think, important to try and reduce your risk, and you can sort of reduce your risk by lowering your loans. And that is something which I think you need to balance it out based on your overall risk profile. Because at times you may be tempted to just keep the loan as is and go and invest it out. But I think maybe a mid path is an appropriate thing to do, especially if you feel that you have you can earn a better return on your investment than on the cost of your loan. But yeah, so from a financial standpoint, at times it may make sense to actually hold your loan when interest rates are low on your loans, okay, and then go back and invest it as well. But like I said, you have to manage your risk.
All right. Okay. Now let's talk about that thing that you mentioned about risk. You know, you tend to be a little more confident, a bit emboldened when you chance upon a windfall gain. Does receiving a substantial high figure objectively, I'm not talking about how you feel, of course, but you know, do you think objectively it really does anything to an individual's risk profile? Does it increase their capacity to take on more risk?
Yeah, definitely, because you know, if for example your assets are higher than your goals and your requirements, then you can actually go back and take a higher level of risk. So a windfall can actually decrease the risk level that you know your risk profile, and you can and you can actually go and take a higher level of risk. Okay, so that is the first thing to keep in mind, that you can take higher risk. But the point is, you should not be rash. Okay, because markets at times, you know, even for the best fund managers, it makes it difficult to predict, right? And if you go back and look at the last few years, right, the markets do its own thing, and you may not expect it at the most unexpected times it will give you a return, and also at the most unexpected times it also makes a fall. So from that standpoint, you know, you need to balance out the risk and return, and I think taking what we believe is, you know, you need to look at a risk-adjusted return, right? So when you are getting into an investment, understand the risk and then invest, and look at seeing that how do I, you know, get the better risk-adjusted return. And I think that is something which will ensure that even in a bad time, right, God forbid, you know, markets fall immediately after, or you know, some other emergency comes up, you know, you're not, you know, in a bad place out there. It is not important just to get the best return, because we've seen you know, people who have got the best return, but then they've also lost it very, very quickly. Right? So you would see that, you know, if you're only in a small cap fund, for example, right, it may give you the best return, but when the fall happens, can you afford a 40 to 50% fall? Right? So from that, it's important to balance the risk, and just because you can take a higher level of risk, it doesn't mean you should be rash and you know, take an unreasonable level of risk.
Okay, well, there you have it. That's everything to do with, you know, how to deal with a windfall gain that many of you may have received recently. Okay, well, it's time to take on board our viewer questions and queries. Then remember, folks, you can email us on our email address, themoneyshow@etnow.tv, and we will get it answered. Whatever your question may be about your financial goals, about your investment portfolio, about where to start investing, shoot an email to us on themoneyshow@etnow.tv. Okay, our next first question is coming from Siddhant Gupta. He asks, how can investors build a separate diversified global portfolio of funds available in India and take advantage of global opportunities? Country-wise funds including exposure of different countries, markets, global sectors, the options available, and how many funds would be appropriate in this separate portfolio? What should be the allocation as well? And also he says that, you know, he has a time horizon of 10 to 14 years, and he very categorically states that he already has, you know, exposure in the Indian markets through direct mutual funds, through, you know, through direct equities as well. So yeah, tell us a bit, Mr. Rego, about global, you know, fund of funds that are available in India. What are the opportunities, and yeah, how much of one's money should be exposed to global countries, global sectors?
Yeah, so first of all, I think that, you know, you need to look at your global investments as on the overall level. So which basically means, I'm saying, if you have 100 rupees, right, and you know, then you can say, okay, I may choose to put, say, 15%, 20%, 25%. I think a level of somewhere around that, because I think India is a good developing market and has good returns. So I wouldn't invest, you know, more than 25%, unless it is, you know, towards a particular need. For example, I have to send my children overseas, and I want to hedge their education costs and the currency fluctuation due to that. So from that standpoint, you know, you look at it on the overall. Now, if the sums that you have, if your portfolio is little large, right, then you can actually look at it also as a separate diversified, you know, portfolio or fund of funds. Okay, and a combination. So what is it that you can do? One is, direct, you can look at mutual funds in India, and there are many of them which are fund of funds which then go and invest globally. Right? At a point like this, you may find that some of the funds which are delivering the best returns may or may not be the best in the future, because we follow a contrarian style, and today we are telling people that we are not wanting a very high exposure to US markets, even though maybe it has been the better performer in the last few years. So it's good to sort of have that purview. And while you're investing, anything, I think it's a good thought process that you have to have exposure to different countries, not just the US. Okay, and of course, you will put some money into the US and look to take advantage of those markets as well, but not all the money. Now, how do you set this up? Now, you can do it, like I said, from the Indian mutual funds, if it is to a certain level of investment. You can also go beyond, right? So today you have platforms where you can invest in global ETFs, and you can actually have a lot more variety of them. Now, it's good to have advice from somebody, or just take ETFs. I think are the best way to look at it. But there again, you may diversify. You may even say, I may take exposure to, say, copper and platinum, and ETFs you would have of them which are not leveraged. Okay, and those are ones which you can also do. Now, apart from equities, you may look at other asset classes which are not so easy to invest. In India, you invest in, say, gold mining companies in India as well and overseas. But what are the funds maybe that for a layman and wanting to take some exposure? I think a couple of funds that I think one can look at. One is, say, a PGIM, the Global Equity Opportunities, and a Kotak Global Emerging Market Fund. That is something that we've kept in mind. Assuming that we don't want to put all the money into the US. Okay, so one could look at a combination of these. You could also look at a combination of ETFs. Today you have a number of platforms also which have come up, which allow you to invest in direct stocks as well. There I must say that, just be a little careful about it, because when the hype is there, everybody comes with great platforms, and there's a temptation to invest. But and most of them are focused only on the US markets, and if that is so, and if you don't have expertise in those markets, if you get to the wrong end of the cycle, then you may lose money. So that's a caveat that you just need to keep in mind. But other than that, I think it's a good idea to integrate your global investing while you are making your investing in India as well.
Okay, well, that's the advice coming in on global portfolio investing. Let's take on board our next question. It's coming in from Raghupati. He says, I'd like to invest 75 lakh rupees in a flexi cap fund and draw 5% on a monthly basis from the third year onwards to beat inflation. He wants to know if his approach is correct. He's keeping, of course, a long-term view in mind, and he also wants to keep capital appreciation in mind. So I think the entire 75 lakh rupees in flexi cap and then start an SWP from the third year. Is that a good idea, putting everything in a flexi cap, Mr. Rego?
Yeah, I think from a standpoint of, if it's a 100% equity fund, right? If you see a market fall, and it's not unusual at turning points of the markets to see even a 40%, or we've seen a 60% market fall in the past. Okay, and what may happen is, when you're withdrawing money when markets have fallen, it may erode your capital very, very quickly. Okay, so we don't suggest that approach. Okay, and I think it's important to segregate, when you're paying out and what fund you're investing into. So what you may do on an overall basis is to say, out of the 75 lakhs, okay, over the next 2-3 years, I will take some money out. I may invest in the flexi cap, or preferably even we would suggest you look at a combination. Why only flexi cap? You may even invest in the mid cap for a part of the portfolio, right? And some bit in large cap. And while you come closer to your third year, you start taking out money maybe for 1 year at a time or 2 years, if markets have done very well. And at periods when markets do well, take money out. So you're not impacting your equity portfolio for money that you need on a day-to-day basis. And then you can do a systematic withdrawal from the debt side and the liquid funds. And there it's okay to erode capital as well. In fact, it will be a lot more tax efficient also, because you are withdrawing your capital. Ensure that at an overall level, between on your portfolio, if you don't want to erode capital, then you need to be careful not to overdo on that. Assume a certain return on equities in the long run, and I think that's a better way to go about it. The other approach, in case you want to just do one fund and you want it to be simple, okay, is not to do a flexi cap in that case. In that case, do a dynamic asset allocation fund, and the dynamic asset allocation fund automatically, as valuations go up, it goes into debt, and as valuation comes down, the balance fund actually moves into equity. So what it does is it ensures that when markets are low, it has not as much money into equity, and it's not eroding your equity capital and pulling out money at distress times. Okay, so that is, I think, another way of approaching it. But I still prefer to do it in equity. After a period of time, on a periodic basis, keep pushing it into a debt fund and use that for systematic withdrawals.